Today, we're diving into a strategy that, honestly, completely flipped how I look at my own financial future. We're talking about why 3 funds beat 40. Now, I want you to picture something with me for a second. Imagine you open up your brokerage account right now. You log in, the screen loads, and boom, you find like 42 different funds just staring right back at you. It's this chaotic wall of stock tickers, fund logos, and overlapping numbers just completely cluttering the frame. Now, looking at that screen, I really want you to ask yourself a very serious question.
Is that a strategy or is that anxiety wearing a spreadsheet? Seriously, is it a real financial plan? Because here's what happens to a lot of really smart, well-meaning investors. And yeah, I'm absolutely including myself in this at one point. We read a few articles, consume some financial media, and we walk away thinking, that sophistication equals safety. So what do? We start layering. We layer on sector funds, dividend funds, a gold hedge, a couple of individual stocks we got a hot tip on, and maybe a little bit of crypto just for good measure. But what we end up with isn't actually a diversified portfolio at all. It's a junk drawer. It's often just a sign of panic masquerading as a plan.
When you put 40-plus funds right up against a streamlined 3-fund approach, the contrast is honestly staggering. On one hand, you've got this false safety of complexity. With over 40 funds, you have overlapping holdings, completely unclear risk exposure, and, this is critical, a system you literally cannot explain to yourself at 11 at night during a stressful market crash. Complexity feels like control, right? But most of the time, it's the exact opposite. On the other hand, we have total market control. Today, we're exploring the idea that the absolute most effective retirement portfolio in the world doesn't require a master's degree in finance. Actually, it fits on a single index card. Just 3 funds.
All right, Section 1. Let's meet the 3-fund portfolio.
So what does the exact alternative to all that 40-fund chaos actually look like? Well, it's elegantly simple. And frankly, adding a 4th, a 5th, or a 15th fund is usually a step backward, not forward. So here is your entire equity and fixed income universe captured in just 3 essential ingredients. First up, you have the Total U.S. Stock Market Index Fund. This captures all the growth close to home. Second, the Total International Stock Market Index Fund. This gives you that crucial global diversification, ensuring you aren't betting your entire financial future on just one single country's economy. And third, the Total Bond Market Index Fund. Bonds are basically there to smooth out the ride, lower the volatility, and effectively give you dry powder for when stocks eventually go on sale.
And this is where the sheer scale of what you own becomes truly impressive. 3 funds equal thousands of underlying companies. I mean, you aren't sitting at a desk trying to pick single winners or outsmart Wall Street analysts. No way. You're simply buying the entire market and letting the global economy work for you automatically. Every company, every sector, every country is represented. It just proves that keeping it simple absolutely does not mean giving up on being fully diversified.
Moving on to Section 2, the silent threat of fees.
Now, it's totally natural to be a bit skeptical right now. You might be thinking, come on, this sounds way too simple, kind of too lazy to actually beat a professional who's actively managing a complex portfolio. But the data reveals a massive gap. Study after study shows that the vast majority of actively managed funds completely fail to beat their benchmark index over long time horizons. And we aren't just talking about most years here, we're talking about most decades. The 3-fund approach isn't about being lazy at all. It's about recognizing that the market itself, over long periods, has already done the heavy lifting and diversification work for us.
And that brings us to the single most underrated variable in retirement investing: fees. When you compare an index fund charging a microscopic 0.05% against an actively managed fund charging 1%, well, the 1% fee sounds tiny, right? It sounds like absolutely nothing. But total market index funds can charge a fraction of a percent precisely because there's no team of highly paid analysts, no massive marketing budget, and no manager trying to justify their massive year-end bonus. You aren't paying for someone's guesswork, you're just paying to own the market.
So the crucial point here is understanding the absolutely devastating effect of something called fee leakage. Compounded over 30 or 40 years, that 1% nothing fee quietly consumes a huge share of your total nest egg. Fee leakage doesn't show up as some scary red number on your monthly statement. It shows up as the retirement you could have had being quietly siphoned off drop by drop, 1 basis point at a time. The truly insidious part? You don't just lose the fee once. Actually, you lose what that money would have earned for you over the next 20 or 30 years. Minimizing your costs is not just some minor optimization. Over a full career, it might just be the single biggest lever you control.
Okay, Section 3, Psychology and Market Panics.
Let's step away from the spreadsheets for a moment, because honestly, The absolute best mathematical portfolio on paper is completely worthless if you cannot emotionally stick with it. We as humans are hardwired with a psychological reality known as loss aversion. Basically, losing money hurts roughly twice as much, psychologically, as gaining that exact same amount feels good. So when the markets inevitably drop 20 or 30%, and let's be super clear here, they will do this repeatedly over your investing life, the biological instinct to sell and just stop the bleeding becomes almost overwhelming.
Now imagine you're the investor holding those 40 funds. When the market plunges, you don't just feel fear, you feel total confusion. I mean, which of those 40 funds is dragging you down? Which ones are you supposed to hold on to? Which ones were even in your original plan? Complexity multiplies panic. But compare that to the 3-fund holder. When the news gets scary, do you really want to be rederiving your entire strategy from scratch? The 3-fund holder doesn't have to. They understand exactly what they own and why. They just rely on one simple, reassuring narrative. I own the world, and the world tends to recover. A simple, good enough plan you can actually stick with will always beat a mathematically perfect plan that you abandon in a panic.
All right, Section 4. 2 ways to implement this. So if you're sold on this philosophy of simplicity and survival, how do you actually put it into practice? Well, we have a fork in the road here, depending entirely on how hands-on you want to be. Path A is the build-it-yourself route. This is where you manually buy the 3 individual funds we discussed, setting the allocation to fit your specific age and personal risk tolerance. Path B is the target date fund, which is the ultimate hands-off, set-it-and-forget-it option. Let's actually look a little closer at that second path first.
If managing even 3 separate funds feels like more than you want to take on, a target date fund is perfect for you. You simply pick the fund labeled with the year closest to your expected retirement, say 2055. It automatically holds that exact same mix of U.S., international, and bond index funds all wrapped into one single ticker. And get this, as you age, it automatically shifts your portfolio from growth-focused stocks to more conservative bonds without you having to lift a finger. Zero maintenance required. Now, it's not totally free. The fee is usually a touch higher for that convenience compared to holding the 3 funds separately. But hey, if you know you won't check your portfolio regularly, that convenience is incredibly valuable.
But what if you choose the DIY route? If you do, there is one mechanical maintenance task you absolutely cannot skip: rebalancing. Let's say you set your target allocation at 80% stocks and 20% bonds. After a massive stock market rally, your portfolio might drift, leaving you with, say, 87% stocks and 13% bonds. Rebalancing simply means you sell a bit of the outperforming asset, the stocks, and buy more of the underperforming one, the bonds, to snap back to your original target. Notice what this brilliantly forces us to do. We naturally end up selling high and buying low, completely without relying on emotional guesswork. You're doing it mechanically, restoring a disciplined plan you set when you were thinking clearly. And honestly, checking this just once or twice a year is plenty.
As we look at the big picture, if there's one philosophical idea I want you to take away from this explainer today, it's this: time in the market is vastly superior to timing the market. The investors who build true wealth aren't the ones who found some clever trick to outsmart Wall Street. They're simply the ones who kept showing up. They made the same contribution from every paycheck, every month, for decades. Through recessions, through rallies, and through years when the news screamed that the sky was falling. Let simple, low-cost plans compound. The market rewards patience far, far more generously than it rewards prediction.
3 funds, low costs, a plan simple enough to trust when things get scary, and the patience to let it compound. That isn't a shortcut, guys. It is the entire strategy. So it's time to ditch the 40-fund clutter. The power is in your hands now. Will you build your portfolio yourself with 3 funds, or will you choose the automated path of a target date fund? Either way, you're taking real control. Thanks for joining me on this explainer, and keep learning.